Hello and welcome to this first lecture of new module on financial asset classes in this course on practical approach to investing your personal finances. So the purpose of this module is to give you an overview of the practical approach to help you decide where to invest your hard-earned money and maximize your returns. And in this lecture, specifically, we will talk about what are the different classes of financial assets. And specifically, we'll talk about some aspects of the fixed income assets, right? So we had a look at this earlier in one of the last lectures where we talked about the various asset classes that you have. And broadly, there are four asset classes that you see here. One is the fixed income assets. They provide the low return and they have very little risk compared to other things that you have. Then there are commodities and gold that are high risk, medium return. Then there are high risk, high return equity and real estate. So these are the four categories, and there are new categories of financial assets. They will keep coming as people keep innovating on financial side. Right. So what are the fixed income assets? So let's take a look at that. So what is your understanding of what are fixed income assets? So the fixed income assets are, as of now, I'm listing eight of them. Cash is a fixed income asset. You have in the past that has been the most used, and even now it's the most used currency, used way to transact. So cash is a fixed income asset. The only thing is it doesn't earn any interest. Then you have money kept in the accounts. You have savings account where you earn interest on your money that you keep here. The current account is kept for business accounts where you don't earn any money interest on the accounts that you keep. Then there are fixed deposits. You can keep fixed deposit in many places as we'll see. There is a bank fixed deposit, there are corporate fixed deposit. So that's how that is. Then there is what is called in India specifically, there is a provident fund and public provident fund. There are two public provident fund is the one that if you're employed, then the employer deducts about 8.5% to 12%, 8.33% to 12% of your salary, or and also makes an equal contribution to create a fund for your retirement. Similarly, there are other than provident fund, there is a public provident fund where you can invest, and we'll talk about that in great detail. Then there are government bonds issued by the governments of the country, and each country has its government bonds, and there are corporate bonds issued by the corporations, companies. And there are fixed income mutual funds. So these are the variety of fixed income assets that we have as of now. So question is, why should you invest in fixed income assets? So what's the rationale of even looking at fixed income assets? Any thoughts? First, the fixed income assets protects you against the dilution of financial accidents. They're very safe places to invest your money. So unlikely, there are financial accidents that happen, but not as often as they happen in other categories like gold, like commodities, the shares or equity and property. So it protects against, and of course it protects you against the dilution versus inflation. It provides you relatively predictable return. The returns are predictable, not unpredictable like property, gold, commodities, or equity for that matter. It generates better return in the long term versus short term. So you keep for a shorter term, you get small amount of return, whereas in the longer term, generally, the returns are much better. You may also increase return and reduce risk in short term on opportunistic basis. So there may be opportunities for short term investments and where you may reduce the risk as well as get better returns. And it reduces the volatility of your total portfolio due to lower standard deviation of the returns. So these returns have significantly lower deviation, 10 versus 30% of equity. So they reduce the volatility of your portfolio and they make it more stable. So that's the case for investing in fixed income assets. So what are the investment risk and concerns in fixed income assets? Are they risk-free completely, or are there some risk and concern even in the fixed income assets? Any thoughts? So there are risk and concerns even in fixed income assets, though they are minimal. One is the increasing level of credit or default risk, along with the higher rate from cash to debt funds. So cash is safest. You keep the money with you. There is no risk of losing that by way of credit or default risk. You can only have theft on cash, and against which you can even insure it. Whereas as you keep moving to debt funds, you start having a possibility of losing your money to someone your money has been given as credit. Then you have the risk of lower trading liquidity. Some of these do not trade very frequently. So typically bonds, fixed deposits don't trade. So you can't, buy and sell them. Then there is cost of prepayment. If you want to prepay those things earlier, you have to pay extra. Then higher, there are taxes that are higher than others, even in the long term. Let's look at some of the details of the tenures and benefits of the fixed income assets. So cash probably doesn't provide any return. It is basically for own use. Current account again is the funds are invested in a bank and you don't get any return on that. Savings account returns from 2.7 to 5% and they're invested in the bank. Fixed deposit can be from 30 days to 10 years, and their returns can be from 2.5 to 7.25% in India specifically. It could vary from country to country. And the interest is tax exempt up to 1.5 lakhs rupees per annum. And the funds invested is loans and credit to people who need it. Then there are government bonds issued by the Reserve Bank of India or the Central Bank of India. They are from lock-in period is 5 years. They are for 7 years, and you get an annual return which is not bad of 7.25%. Then there are corporate bonds which are issued by the companies, which could be from 3 to 5 years, and then you earn a higher rate of return from 9 to 12%, while the risk is much higher than compared to the government bonds. Then there is a PF and PPF, which is fully tax exempt in India specifically, and you earn about 8% return on that. PPF has a lock-in period of 15 years, and the proceeds or the funds are invested into regional provident funds or government bonds itself. And finally, there is a fixed income mutual funds that can be from 6 months to 1 year, and they could be even as with no lock-in actually. The liquid funds specifically we'll talk about. And the returns normally is about 7 to 8%, and these get invested into money markets and partly into equity as well, up to 20% of the total funds that you have. So that's an idea flavor of the fixed income assets that you have. So what do we do next? Having looked at a broad idea of the fixed income assets, we will now look at specifically some idea of into more details. So we will take a look at fixed deposit in a lot more greater details in the next lecture. So thank you so much for watching this lecture, Financial Asset Classes, the first lecture in this course on practical approach to investing personal finances. I hope you continue to learn something new, continuing to enjoy, and I do look forward to see you again in the next lecture.